Two highly anticipated meetings took place today with the Bank of England and a European Central Bank rate decisions. Senior currency analyst Matthew Foster-Smith from Thomson Reuters IFR Markets is a regular contributor to Dukascopy TV. To get the very latest on some of the most traded currency pairs, he now joins me on the phone. Hi Matt, we'll start with the pound dollar. The Bank of England made some tough calls today but decided to expand their bond purchase plan. So how is this going to affect the level of the pound dollar through to year's end and indeed into next year?
As you said, sterling hit a 14-month low against the dollar after the BoE launched its QE2 today, £75 billion sterling. Not the brightest of starts. I've just been reminded by one of my colleagues of a very interesting comment from George Osborne, who said in 2009, printing money is the last resort of desperate governments when all other policies have failed. He said that in January 2009. His comment this morning, after the Bank of England launched QE2, the Bank of England has just engaged in a very positive move. So there's a bit of a turnaround in policy there somewhere. Cable itself, 14-month lows, as we just said, and the pound is not looking good into the year end. Further weakness predicted. In a month's time, 150 is a bearish target. Into the year end, we're certainly looking for a fall into the 40s. IFR Markets potentially in 3 months' time projecting 145. But into the 1 year prediction, well, we're hoping the sterling will recover, possibly get back to 155. In the near term, the sluggish UK economy, poor sentiment in Europe and things like that, they're all going to be a particular pressure on the pound.
OK, well, the ECB resisted temptation to cut interest rates in Jean-Claude Trichet's last ever ECB meeting. But how has this affected your short-term forecasts for the euro-dollar, and what are your long-term forecasts looking like too?
Absolutely, another net negative out of Europe, I'm afraid, moving from a proactive central bank to a not so proactive central bank. ECB leaving rates on hold against many in the market's predictions of potentially a 50 basis point cut. Coming into the meeting, markets had predicted that rates would be on hold. However, the closer we got, the more aggressive expectations were for a cut. But it's another bearish forecast, I'm afraid. So the euro down in 1 month's time, so euro-dollar potentially to 130. I've seen some very aggressive 129 targets. They're also very feasible, perfectly viable in the 1 month. Just from a pure market perspective, there's a lot of optionality into the 130 area. 130.50 and 130. There's been a lot of talk about these levels in the short term, so these could be protected. The level could be fortified in the short term, so we could see a lot of buying ahead of these levels, which could slow the rate of the descent. But sentiment towards the euro is negative, so euro-dollar heading lower, going below 130 into the year end, 127.50, potentially 126. But in the long term, as I said, it's all negative, and this is only going to return the onus onto European officials, but we're then going to have to find some sort of official policy to move crisis-hit banks away from the liquidity support that they're getting. So yeah, in the 1 year, a slight recovery, maybe back to 135, 140 is doable, but certainly that's looking very toppish now.
And finally, what's your opinion on the US dollar, Canadian dollar?
Commodity currencies have taken a very, very big hit. The Aussie, the Kiwi, the CAD, they've all come significantly lower against the big dollar as it has its slight revival into Q4 and potentially the year end. But fundamentals very solid. So what we're expecting at IFR Markets is for the CAD to actually come back, claw back some losses into the medium term. In the short term, it's going to be a very, very vying for strength. So dollar CAD, we're expecting levels of roughly where we are now, 105 in the 1 month, potentially 107.50 should the dollar continue to strengthen. Should European fundamentals turn significantly more negative, then obviously that's going to boost the dollar by default. But in the sort of medium term, year end, 3 months, well, we're looking for the CAD to come back to parity, and into the 1 year in the longer term, back to sort of the 0.9 area, with commodity currencies as a whole, Aussie, Kiwi, CAD, all coming back into positive territory.
Thanks a lot, Matt. It's always a pleasure speaking to you. To keep you updated on the latest forecasts from some of the biggest financial institutions in the financial market, check back in next week for more Targets in Focus.